Okay, hello everybody. Thanks for joining me today, and thank you, David, for the invitation to this wonderful event. Great speakers so far, and I'm sure all the rest of the speakers will be just as wonderful and interesting. So thank you everyone for attending and taking the time today. We're going to go through understanding the markets in 2025. So let's get right into it. So everyone wants to know initially, where is the bottom in the S&P 500 that we're now going through this pullback and this retracement or correction, as people would say. Where are gold and silver going? Should I be buying gold and silver stocks, and which ones? Is it time to go shopping for stocks? Should I sell stocks now? Where is the economy going, and how can I profit from the market? So we might start right at the bottom with how can I profit from the market? So how to make money from the markets? So you can buy stocks and enjoy capital growth and dividends on the stock. And when you're buying, I'm just going to put people up here so I can see what I'm doing. When you're buying, you can buy at different levels and be very consistent, and that actually builds your wealth. So if you set up a consistent investment into an index or a group of stocks that you really, really like and are very profitable, have good dividends, you should be investing every month, no matter what the market is doing. And that's the way to build really good wealth. Also, you can focus on a sector and build a ladder of positions. So as I just said, not just buy a stock and just leave it, but keep buying it, build a ladder of positions. So you can focus on one sector, like the tech sector, or you can spread your investment and your ladder across various sectors. But just keep buying, keep investing, and that just multiplies your wealth. Or you can use different vehicles. So each of these vehicles could be, one could be stocks, so you buy stocks. You can buy options, you can buy leaps, and you can buy ETFs. So you can do all of those things, use all of those vehicles to increase income and increase wealth. So by using different vehicles, this is an explanation of what I mean. So say I wanted to buy Tesla or NVIDIA, I could buy a parcel of the stock, I could purchase options, I could purchase ROM, the technology ETF. So what I'm saying is you're multiplying your returns in a great way by incorporating these various vehicles. So this is what I did back in 1996. You can see here when Commonwealth Bank of Australia floated. I bought 300 shares at the time, and it was $6. So you paid it in two tranches. The first lot was $4.45, and the balance was paid the following year. So as of yesterday, CBA was worth $148.63 Australian. So when we had the meltdown in 2008, a lot of the companies sent out share purchase plans. So you could add to your shares that you already had. So this was the Commonwealth Bank share purchase plan I got. And the offer closed on the 11th of March, 2009. So that was just not long after the 2008 meltdown. So you could buy, a tranche of 1,000, 5,000, 10,000, 50, 150, 250, whatever you wanted. So it was roughly $26 at the time. So I just sent a check of $10,000 to invest further. So building my ladder, just building my ladder. And I got various other companies sending me these share purchase plans as well at the time. So when we talk about options, bull call debit spreads or bear put spreads are a vehicle that you can use to create income in the market. So for example, the bull call debit spread has two legs. you buy a call option, you sell a call option at a higher strike, and the maximum loss is limited to the initial debit paid. And the advantages of debit spreads is there a higher probability of profit, lower cost, and limited risk. So that's why people say that they're so wonderful at creating income. But I really want to stress there is no single market secret to discover. There's no single correct way to trade the markets. So you might choose options as just one vehicle that you really like to do. And that is absolutely fine. I mean, I choose stocks, I buy stocks, and I choose options, and I choose leaps. So I have all those three vehicles going at once, but there's no single way, one way that's correct. It's totally up to your philosophy. So I'd like to talk a little bit about the illusion of knowledge in the financial industry. My husband and I in 2005 handed over our funds to an investment banker. And he came one day to our place and showed us very pretty graphs and fancy terminology and very complex plans that, absolutely terrified me. I didn't know what he was talking about. And it's really, really designed to overwhelm and intimidate the potential investor. So after charging us $30,000 a year and our portfolio going backwards and the buy and sell statements creating about a 4-inch thick folder, I decided to take over control of our investments. And it was just as well I did, because they sent a letter and said that they would have us fully invested by May 2008. So I'll let you think about that for a minute. So investing is for everyone. I don't care how much money you've got, how much money you earn. It's for everybody. Just put a little bit away every month and you will be investing and creating wealth in the long term. So this is a few notes on Jackie's post here. The return on portfolio for the calendar year 2024 was 30.82%. I've been warning on the coming bear market to my Jackie's Post tribe, which I call, several months ago, so we were well prepared. These are some profits that we've taken recently or before the bear market started. Arista Networks, 86.29%. Taiwan Semiconductor, 48%. DigitalOcean, 29.35%. BlackRock, 29.63%. And as I was talking about Dell, I did a ladder of stocks here, and we took very nice percentage return on Dell. Palantir, we bought at $23, sold out at $112 for 390% return. And Tesla, bought at $260 and sold at $328 for a 26.34% return. As I had in my Zoom group, which I have once a month, and it's actually coming up at the end of this week, I had this slide in the end of last year, beginning of this year. There is a bear lurking, and be prepared. So that's what I was doing for my group in the beginning of the year and toward the end of last year. So I was warning them about what was coming. So what do I need to know before I enter a trade and investment? So it's basically a process you need to think about and understand before you purchase or trade. So you need to know the macro picture. Is the economy growing or is it going backwards? So if it's growing, you obviously need to do bullish strategies, which include calls and call spreads. If it's shrinking, you need to do puts and put spreads. So you need to think about, where is the economy headed next? And I think if we think about the economy as it is today, we could think that maybe it's not headed to such a good place. Then you need to target the good industry fundamentals. Focus on a handful of industries that are booming. Follow the leaders and skip over most of the rest. So then you need to get clear on the micro picture, zero in on individual companies to trade, and that will be your micro selection. So individual companies return double or triple the returns compared to stock indexes. But of course, there is a greater risk trading individual companies. As we know, when there is an earnings call and there is a miss, they can certainly go down the lift shaft. You need to then hone in on the technicals, be able to read the chart, identify the patterns, and if you do candlesticks, that is also very useful as well to identify the potential direction of a company or an index. Then you need to know your calendar, whether it's your sell in May and go away, which has worked numerous times. So if you invest in November and sell in April, May, you would be up over 7% compound annual return. So if you're trading outside the US time zone, it often could be a bit tricky. So you need to, well, my advice is to get up early in the morning, each 1 hour before the market closes, and employ a longer term time horizon. For example, do more leaps. Put in several different price orders to ensure your trade is taken. And buy stocks, and as I said, keep scaling in at regular intervals. So what's all this about leaps? Okay, they're option contracts with expiration dates that are a year or longer. So they're the same as an option, but the expiration date is just longer term. So why would we do leaps? It allows investors to benefit from rises in a specific stock while using less capital than purchasing shares with cash up front. So less cost overall. So this was a great opportunity here. I'm just showing you where to buy leaps. This is how you must understand how to use leaps. So during the COVID crash, we came straight down the lift, and this was March 2020. Now, this would have been a great opportunity to put on 5 or 10 leaps, because by February 2021, look where we were. And these leaps would have been worth a lot of money. And that was your return. Just put on the leaps there and then take your profits here. So the stock market trading and investing is 20% mechanics and 80% psychology, which is why it is actually so difficult for many people. So many of us are controlled by FOMO, fear of missing out, or FOMM, fear of making mistakes. And I would also add one in there, FOLS, fear of looking silly, because you don't want to do something that looks stupid to other people. So you really are tied up in this area here. So you really have inertia and you don't do anything. Or with FOMO, you jump in at the top of the market with the herd because you don't want to miss out. So this is what I'm saying, showing you the Australian share returns over a rolling 12-month period. Here are the returns. And this is why people jump in and out of the market. So you must understand how the market moves. And this is what it looks like. And this is why nobody can stay in the market long term, because they think, oh, it's going to zero. Oh, I must get out. But if you look at this green line, this is the rolling 20-year return line. So this is fairly stable. So if you look at the long-term returns, this will keep you in the market and keep you safely invested. Just forget about these gyrations here, because that will put you off. But that's what the market looks like, and you've got to get used to that. So here we have up here, this is the herd. This is what I wanted to point out. This is euphoria up here, where everyone's in and thinking, oh, it's great, the market's going to keep going up. This is when the herd jumps in to increase their positions despite high valuations, the area we have just been in. We have had hugely high valuations of stocks, and people have just been jumping in consistently, even though we have had that landscape. And then once the market starts to fall, anxiety starts to set in and losses start to mount. Then we're in denial. It's going to turn around, it's going to come back. Then we start to hit the panic button, and then capitulation happens. And the herd accepts its losses and completely exits the market. And then what happens is the sophisticated investors take over and buy at the bottom here. So disciplined investors restrain themselves from participating in panic buying. In the face of volatility, long-term investors stick to their convictions and avoid making rash decisions. So having weathered the storm, rational investors once again see an attractive opportunity. So this is the time people like Warren Buffett would be rubbing their hands together thinking, oh, this is a great time to buy. So like here, we can see Australian shares have climbed a wall of worry. You can see all the things and events that have happened. And it's rocked the market to a certain extent, but it's always kept going up. Even after all these events, it has still kept rising. So it will be the same. It'll be the same with COVID. It'll be the same with the event that's happening now. The market will keep rising into the future. The emotional side of investing. So this is the roller coaster you go through. You're hopeful here, excited, then you're ecstatic because you could see your shares have gone up, or your leaps have gone up, or your options have gone up. But actually, don't forget to take the profits off the table when you're up here, because there will always be this cycle. So then the unsophisticated just leave it there, don't take their profits off the table, become nervous, then they become desperate, thinking, oh, it'll turn around. Then panic sets in. And this is when the sophisticated investors pick up all the sold stocks and options from the people that were throwing them out the window. And so the whole cycle continues. Making money in the market, so psychology. So the 6 basics of stock trading psychology. You need to be able to manage your emotions. And as I showed you before with that slide of this 12-month returns of stocks, you need to be able to manage your emotions when you're looking at that. You need to be able to maintain a discipline after you've developed a trading plan. You need to be able to stick to it no matter what. Understanding market behavior, and I'll go through that a bit later. Overcoming biases. And as I say, it's my favorite thing to look long term, because that's going to level out all that volatility. So this is why we mess it up. We have overconfidence, loss aversion, and confirmation bias. So overconfidence, we take unnecessary risks, making unrealistic assumptions about the markets. And this can lead to a lack of discipline and failure to follow a trading plan. So the trading plan basically goes out the window because you think, oh, this time it's different, but it's not. Loss aversion. This is a bias that causes traders to hold on to long positions for too long, hoping that the markets will eventually turn in their favor, so turn around. So at the top, there's a herd mentality when everybody's in at the top. And once it starts to turn over, you can see that this loss aversion kicks in. So you're thinking, oh, the market will turn around and will go back up again. And these people They keep holding on to their positions and they keep losing, and keep losing. That's why you must be disciplined and observe your stop losses. And it can certainly lead to significant losses and a lack of discipline in time management. So be willing to cut your losses and move on to the next trade. There's always plenty of trades. Confirmation bias. This bias can lead to traders to seek out information that supports their existing beliefs and ignores information that contradicts those beliefs. So consider all available information and do not be influenced by preconceived notions. So practical steps to take: be realistic about your abilities, set realistic goals, and be very disciplined in that, and be disciplined in your risk management. So mindset is everything in both trading and investing. You need resilience. So if you have 2 or 3 trades that didn't work out, you need to be able to jump back in and keep trading, keep investing. You need patience. So wait for the setup to come to you. You must understand that the markets will try and suck all the money out of you and make you lose the money. But you've got to be patient for the realistic setup that's going to work for you. You must be focused on what you're doing, and exercise. I'll talk about that in a minute. Okay, you need to get comfortable with market movement. So with that slide I was talking about before, with the market volatility. So the practical steps you can take: open a brokerage account and deposit a small amount of funds so you're prepared to trade and invest. Observe how the market moves, for example, on the SPX index. Compare the movement on the daily with the movement in the 4-hourly, the 30-minute, the 15-minute, and the 5-minute charts. So it's only when you are using real money, not just play money, that you can learn to understand how the market movements will make you feel. Okay, this is a book that I've always recommended to my subscribers and my group, The Psychology of Money. It gives you an understanding of how you behave around money and how people lose it, spend it willy-nilly on things that you don't need, and how they don't invest it in a disciplined manner. Successful investing and trading is more about behavior than the mechanics. So our practical insight would be to look at your personal finances, know where your money goes. Warren Buffett says, do not save what is left after spending, instead spend what is left after saving. So a strategy is, if you wanted a really simple strategy, allocate 90% of assets to low cost S&P 500 index fund and 10% to short-term government bonds. An index fund, Vanguard, is one that comes to mind there. So, investing really doesn't have to be complicated and complex. This strategy brings simplicity, lower fees, and the potential for higher returns to the investing process. So here let me go back to the benefits of exercise for the trader and investor. It really keeps the mind sharp, and for traders, this is essential. It improves concentration, gives you better mood, and it reduces your stress levels. I know we all feel after we have a run, a bike ride, a brisk walk, a swim, that we all feel much better and our focus is much better. So it releases hormones like dopamine and serotonin, which help improve focus and concentration. And it's good with controlling impulse control and fear management. So we need, as I said before, when you're looking at the markets, you need to understand that the market must come to you, not you chase the market, not you chasing a trade to do. Because trading is 10% buying 10% selling, and 80% waiting. And the stock market is a device for transferring money from the impatient to the patient. So if traders learned to sit on their hands 50% of the time, they would make a lot more money. So time in the markets, not timing the markets. This was the worst investor in the world. He bought at the top of each market of each decade and still fared pretty well. So he put 500,000 in overall and 100,000 in at the top of each market top. But he still came out after that 500,000 invested at the top with 7,782,639, which was a return of 1,557%. So even if you can just, you can still invest at the top, but invest along the way. So you're basically dollar cost averaging all the way through. So the benefits of writing a written record. So if you keep a written record of your trades or your investments, it compels you to organize your thoughts, and it boosts connectivity between different areas of the brain, and it makes you retain the information a lot better. And you can learn and grow from your mistakes because you can look back and see how far you've come from where you started and know that you've actually improved. So, writing things down includes writing down your philosophy towards trading. Are you going to trade every day? The time of the day, the strategies you're going to use, which sector you're going to trade, or is it just one sector or all the sectors or a specific stock? Some people just trade bonds. Some people just trade Tesla. So it's totally up to you. So the entry period, what time period do you use to enter the trade? How do you exit? Do you take half off and let the other half run to a secondary exit level? What size of the trade? My advice is to start small and accumulate over time and average in. So know your exit level and place when you place your trade, so you can have more than one exit level. And the stop loss must be just placed above the resistance level or below the support level. And remember not to place too many trades so you can manage all those trades and investments. So understanding the markets involves being able to read the charts, identify patterns, and if you know candlesticks, it's also very helpful. So the best chart patterns to be able to identify are a few here, which I'll go through: head and shoulders, double top, double bottom. And I'll just go through a few here. This is the head and shoulders. This is what the pattern looks like here. And if you draw a line under the neckline, this is often where you can put a trade entry to be taken when it breaks through. So I'm just going to say that not all head and shoulders patterns will, follow through here. The double top, the same thing here. If you draw a neckline underneath and put your entry order here, and make sure you have a stop loss up here just in case the pattern doesn't follow through. This is the flag. Flag, and you'll notice that this can be interpreted as the flag pole leading up to this flag pattern. And you'll notice here how the price action continues in the direction of the original trend once the price breaks out of that flag. Triple top, or what I call 2 points makes a third. It's one of my favorite patterns to be able to identify in the market. So here you can draw a line at the top, draw a line at the base, and then the distance between here and here is the measured targets where you can, your TPP, take profit target. So you would also put your entry order here, but be careful and be aware that this can happen here. It can retrace up here before it actually comes through and follows through with the bearish direction here. Candlesticks. In a bullish direction, we would see the inverse hammer, a bullish engulfing candle. For the bearish direction, we would see a hanging man, a shooting star, a bearish engulfing candle, and a spinning top. And continuation pattern candles involve the doji and the spinning top. So let's have a look at a few here. Okay, this is at the top of the range. This is what we call a shooting star, and the potential direction is bearish. So if we see that, with the market might move in a bearish direction. This is the hanging man, and it looks just like a hanging man, the head and the body here, and this is the potential direction here, bearish. This is a hammer at the bottom of a range, and the potential direction here is bullish. And this is an inverse hammer, and the potential direction here is also bullish. Right, onto the S&P 500 monthly chart. Now, this was a chart I illustrated at my recent Zoom monthly meeting. I wanted to show an overall picture right back to the COVID low of 2020 of where we actually were. So it has now just broken here, and we were actually in a wedge here coming up, and I was just waiting for that wedge to break. So I told everybody that a break of 5773 will be a very bearish move. So I had prepared everybody to have trades in place if that break occurred or when it occurred. The minimum target I see is 5,000. The maximum target I see happening is for 4050 on the SPY, but it's not likely to break this area 3491. And here is the COVID low of 2020. This is closer in, the close up here. So we've already broken out here, and this is where I'm seeing that this retracement and correction can actually go actually below 5,000 to around 4,800. And of course, we're going to have retracements up. It's not just going to be a straight line. So we're having a retracement at the moment, but after that retracement, I would be telling all my subscribers and followers that to put, bear put spreads, puts on, etc. This is the daily index now. As you can see now, we're retracing. We've had this big move down, and now we're retracing up here. So this is the area now that you need to think about bearish strategies. Treasury bond yields. So what's happening with this market? Okay, this is the 40-year downtrend that we had here, which ended at the March 2020 low here. And we've since gone up and reached this 5% level here. Now we've been retracing lower for a small amount of time, but even though the Fed reduced interest rates, the yield has still been increasing. So what I expect to happen is for yields to keep rising, and that could happen in the next few months and certainly next year and the year after, as I expect interest rates to actually rise. This is the 10-year yield chart going back to 1960. And you can see this is the weekly overbought readings. And you can see here, we have an overbought reading here where we are now, and one back right in 1980 and here in 1970. So if you remember back in 1980, the interest rates were 16, 17, 18%. So I am anticipating that we start to rise up to initially the 7 to 8% area, maybe at the end of this year into next year. So they say that history doesn't repeat, but it does rhyme. And the US national debt is something that certainly needs to be seen to and dealt with because it's just going to keep increasing, and that's making countries around the world very nervous, and certainly citizens in the US very, very nervous. They're not so complacent around it now. By the age of 30, each person in America would owe $209,707. So it's just going to keep rising, and it certainly needs to be addressed. So gold versus US Treasuries. So this is what's been happening since 2010. Treasuries have been falling and gold has been rising. So central banks have been buying gold like there's no tomorrow, and certainly individuals have been buying gold as well. And treasuries have been sold, and they're not now as popular as gold. So what's happening with gold? Excuse me. The movement in gold has decoupled from its economic and financial influences. There is certainly a geopolitical angle present, which is overwhelming the economics and the finances. So who is buying the gold? It's foreign central banks. And why are they buying it? Diversification of the reserves away from the dollar. It's basically de-dollarization. So the gold becomes a store of value and a protection of wealth. So basically, the gold cannot be confiscated, excuse me, or sanctioned. So there's talk about revaluation of gold. It's currently priced at $42 and I think 22 cents. And they're thinking of pricing it in today's price, a notion to pay the US debt down. I don't know if that will happen, but there's certainly talk about it. So a recap, what's moving gold? Central bank buying certainly is. Market sentiment is certainly leaning toward the purchase of gold. Economic and geopolitical uncertainty is there right up on top, forcing people to purchase gold, and industrial applications to be used in AI, where gold is used. Gold price predictions. This is where gold is predicted to go. So we're already touched 3,000 and just above. 2025, we're forecast to go to nearly 3,500. And by 2030, we should be 9,000, close to 10,000. And I see that is perfectly possible, those levels to be reached. This is the gold chart, and we're here at the moment, up here, and we've just retraced a bit, but we've certainly had a huge run up in the last several months, in the last half year. So the factors influencing the silver price in the future are a lot the same as the gold price. There is monetary policy decisions are a huge influence, certainly geopolitical tensions, and certainly uncertainty in the economic landscape. And of course, there's major mine closures, which forecast a reduction in silver supply. And this is the daily silver chart, basically almost similar to the gold chart. And we're now having a pullback and a rest before we, get more energy to keep the rally going. So where's the demand for silver? As we know, it's not only in jewelry, it's not only in bullion. There's a huge amount used in industrial areas and also in solar. So silver is not just the pretty metal, it also has huge industrial use. And it also has applications in tech and batteries, which will drive demand higher. So where can we put our money in silver? You can buy silver coins, silver bars, purchase silver ETFs, such as iShares Silver Trust, SLV, the Aberdeen Physical Silver Shares ETF, SILV, ProShares Ultra Silver, AGQ, and purchase silver futures contracts. That's for some experienced investors, or the Wheaton Precious Metals. So these are the shares I've got my group and investors and subscribers in. SLV, I recommended it on the 15th of February 2024 at $20.70. So way back here last year. And this is where we are now, $29, nearly $30. This is Wheaton Precious Metals, again recommended on the 15th of February 2024, way back here at $35, and now we're nearly $75. And of course, my mantra, my philosophy is to buy a ladder. Keep buying a ladder of positions. So I recommended to all my subscribers to keep buying all the way through. So gold and silver stocks I recommend are Barrick Gold, Van Eck Gold Miners, and GLD. And this is the GLD chart. I recommended the stock here and also Leaps here when it was $215. And that was on the 21st of March last year. So now we're up to $277. So the Leaps would be doing very well indeed, as would people that bought the stock. Barrick Gold is a similar story. I got people in on the February 2024 and 15th of February 2024, both at different prices using the ladder concept. And of course, we're now at nearly $19. GDX, the same story, again, in on the 15th of the 2nd, 2024, right around here at $26.30. Currencies, the US dollar has been falling, as we've all seen, and that's symptomatic of the economic environment in the US. And I would see that the US dollar would continue to fall in the long term because of the fiscal situation in the US. You can see here that the euro has had a huge rally in the short term recently. And that was rallying on the back of the Ukraine-Russia ceasefire negotiations and funds pouring out of US into Europe. So, but the ceasefire negotiations may not come to pass. So I would question this rally and it might actually peter out. So I'm watching this closely. This is the US dollar yearly chart, and you can see how far we've fallen from the top down here. And I think we have still a little further to go. Crypto and Bitcoin. This is the weekly Bitcoin chart. And this is where I see we are now. Now, I'm predicting that we can either run up from where we are now, or we actually retrace here to make a third point. Remember, I talked about 2 points makes a third. So if we make a third point here, that is a very bullish place to start from. So that would be in the low 70s round about that third point there, or in the high 60s. This is here on a daily chart. This is the 3 points here that I'm anticipating and looking for. And this is what traders do look for. They draw their line and they look for this potential third point. And they put entry orders here. So we either rally back up from this position here, or we come back to make this third point and then rally. So I'm anticipating the target to be about 128 to 160K. And I'm telling everybody to put a stop at around 70 or a max of 60K. Michael Saylor of MicroStrategy, which is now called Strategy. He provides business intelligence, mobile software, and cloud-based services. He's bought 8 billion of Bitcoin since embarking on the Bitcoin strategy from August 10, 2020, and he's up 840% since. The future of digital assets and tokenization. According to Larry Fink, the CEO of BlackRock, he believes tokenization and exchange-traded funds will revolutionize finance. And many experts believe the tokenization market could reach 10 trillion in 2030. So he believes Bitcoin is an asset class in itself. It is an alternative to other commodities like gold. And Fink believes tokenization will be 100 times bigger than Bitcoin. So how do you get involved? BlackRock's 10 trillion tokenization vision, the future of real-world assets. The BUIDL is the BlackRock USD Institutional Digital Liquidity Fund. It's a tokenized fund created by BlackRock that operates on the Ethereum blockchain to offer US dollar yields through tokenization. Asset tokenization explained by Larry Fink. And if we've got a few minutes here, 6:48, I don't know if I've got time to play it, but this is it. And I think I'll send it to David and he can distribute it to all the listeners here, because I don't think we have time. So what is it? What is tokenization? It refers to turning physical assets such as real estate, artwork, or commodities into digital tokens residing on a blockchain. These tokens signify ownership of a share in an asset, facilitating its exchange or transfer. Blockchain technology promotes security and transparency. So which assets? As I said, it can be physical assets like real estate, art, equities, bonds, and even intangible assets like intellectual property or even identity and data. So the benefits, it democratizes assets. There's a piece for everybody. It lowers barriers to entry, increases liquidity. It brings immediate settlement. It's cheaper for the buyer and the seller. There's no middleman, and it's very transparent and secure. So I participated in a gold token, and I'm just about actually to buy a silver token. So it's quite exciting. A little bit about my background. I've worked in mental health and drug and alcohol unit for 10 years at the Toowoomba-based hospital. I studied while working and finished with an MBA. I've run my own fund. I've worked for the Mad Hedge Fund trader for several years. I've also had a stint in the outback as a cowgirl, or jillaroo as we call it here in Australia. What have I done with my funds that I've earned? I'm very big on education. So I sent my son to a private prep boarding school in England, in Wokingham, and this was the school called Ludgrove. The fees were very exy, 9,000 plus per month and pounds, and that was 3 per term. So it basically cost me about 60,000 Australian dollars a year over 5 years. And we took holidays around the world in Europe and the US during the summer term, and this was in Lake Tahoe in the autumn. And while Alex was at summer camp learning French, I was hiking and enjoying lunches by the Thames. And this is the Gold Coast, and this is up north near Mackay. So these, Warren Buffett has some really great investing tips. One of these is a couple of these are my favorite. Most news is noise, and the best moves are usually boring. So what I'm trying to get across is the landscape, the investment landscape will look very, very different in the years ahead. And, you know, the question is, are you going to be able to identify the winners from the losers? Which ones are going to be the best ones to pick? Because there'll be a lot of new stocks coming through, especially with AI. So would you like some help in being able to make some money and increase your wealth? We all know that only a very small percentage of traders profit net of fees. And we all know that only 7% or so remain after 5 years. Most people quit after 2. So we need to understand that the markets are very unforgiving, and emotional trading always results in losses. So this was, I'm just going to shift this over here. This was the annual return over 90 years of the stock market. So you can see here the median annual return was 14.32%. And this is my argument of staying invested over the long term, so you don't miss these very, very good years here. You do have down years, but if you try and time it, you will miss out on these really good years. Okay, put you at the top again. Here. Okay, so could the SPY rally to 14,000? People often ask me this. There have been 2 secular bull markets since 1929, with both generating 2,300%. So if the current cycle, which is, shift this up here, which is around here, moves toward 14,000 by 2034, which is when we can expect the current 16 to 18-year secular cycle to peak. And this is entirely possible. In fact, I think it's almost a certainty that we get to that 14,000 peak or even more. And this is why we will get there. It will be all about technology. It will impact all sectors: health, finance, transport, agriculture, housing, retail, quantum computing. All of these things will become very advanced. I mean, we've already got autonomous vehicles on the road. Next thing we'll have is flying vehicles. We'll have anti-aging drugs. We'll have huge advances in medicine, curing diseases. We'll have space mining and quantum internet. And that is going to really drive the market up into the stratosphere, basically, for not only the next 10 years, but really the next 30 years. So how do I benefit, or how do you benefit from Jackie's post? You get up-to-date information on the market, the economy, and geopolitical events, 3 newsletters a week. You learn about market terminology as you go. You get a summary of John's webinar that he performs once per fortnight, and I write a summary and send it out in a post. You get trade ideas and an explanation of why the trade is a good idea. We have Zoom monthly meetings where I hold a meeting and bring subscribers together and connect the community, where they can discuss anything they like about the markets, companies, trades, geopolitical events, anything, and I join in to see if I can answer their questions. I also occasionally hold social occasions. This was a lunch in January 2024 in Melbourne. Testimonials, we have a few here. Larry says, I'm awesome. Ralph says, I'm a rare resource. And James says, I have consistent, accurate analysis of the markets. And here we have John Morrison. I won't read all this out, but he basically says, I shut out the noise and focus on the opportunity at hand. So what you receive with Jackie's post, 3 newsletters a week, a summary of John's webinar presentation sent out once per fortnight. Trade investment ideas will be shared when the risk reward is in your favor. Monthly Zooms to educate, share ideas, experiences, and ask questions. So this is the price in the store, is $5.97. Today, only for today, it's going to be $3.97 for 6 months, a saving of $200. Plus, you'll receive a free trade alert, options trading for beginners, a PDF, and options trading for beginners, a video series. So click on the link on the right in the chat box. Okay, so this is the mystery chart that you're going to receive. You have to work out, is it a buy or is it a sell? So if you purchase my newsletter today, you'll receive this trade alert direct to your inbox, along with those other PDFs and video series. So make a decision, change your life. $3.97 for 6 months is an amazing offer. Click on the link and join our community. Take charge of your financial education. Learn about the markets, boost your income and your wealth. Click on that link, and I'll leave you with one quote from Warren Buffett. What is the best investment? The best investment you can make is an investment in yourself. The more you learn, the more you will earn. Okay, I think my time is just about up. I have 3 minutes to go. So, David, have I got any questions in the chat?
Someone asked, can you show me what an alert looks like?
An alert? An example?
Yeah.
Let's see. Is this here? Trade ideas, explanation. So I would have alert of buy. I haven't got an exact presentation of an alert, but I would say buy the stock at this price. And then I would say create, as I said, I like to create a ladder of opportunities. So I would say buy again the next day, buy again the next day. So that's how I would present it. And if I was doing an option, I would give the exact option price and expiration. If I was doing an option, a 3-month option, a 6-month option, or a leap, I would give the exact numbers.
All right. I think that's the only question, and we're about out of time. So thank you, Jacqueline.
Okay, thank you. Thank you so much for listening. Really hope you learned something. And just